Well, thanks a lot for that, Sapna. Well, by the way, we have the results of TCS that are flashing for you on the screen. On the top line, it appears pretty much in line with what we're working with, coming in at around 61,237. So that's the number that we have out there. The profitability, though, appeared better than what we were working with, because the profitability came in at around 12,240. We were at around 12,080 approximately. But I think the EBIT number is a little bit... it's a little bit better than what we are working with, because the EBIT number has come in at around 15,918, which means margins at around 26%. Rima is joining in from the site itself. Rima, on an operational front, it appears these numbers are a little bit better. The top line's in line, the PAT was much better, and that appears because of an operational performance. So give us your first take on it.
Well, the first take is that it's a big margin beat. The EBIT margins have improved by 100 basis points on a quarter-on-quarter basis, 26%, versus estimates of 25.3%. Margins are the best that we've seen in 12 quarters. The previous best, the recent high, was 26.85 in Q4 of FY21, which is when the maximum of, the post-COVID benefits came in because of lower travel. After that, margins have been on a downward trajectory. Margins went down, almost down to that 23.1% band, and since then they've been rebounding. So 26% margins will come in as a big beat, and the street will like that. The question is, are these kind of margins sustainable? One factor which could have driven the margin gains is the fact that the headcount of TCS has been declining. In 3 out of the last 5 quarters, we've seen the headcount moderate. In fact, in the last 5 quarters, headcount of TCS, the number of employees, has fallen by 12,900. Plus, of course, the company is working on other efficiency levers, whether it's automation, bringing down the subcontracting cost. So all that is helping. But I think amongst the numbers that we have, it's the margin performance which is a big, big beat. The street, and maybe this, the market sussed that out, because as you guys have been pointing out, TCS today ended at the day's high with a gain of about 0.5% at a time when the Nifty IT index ended with a cut. The Nifty IT index was down close to about 1%, with individual names like Infi, HCL Tech all showing losses between 1 to 1.5%. So maybe the markets had an inkling about this margin beat, given the kind of performance. And just to map out TCS's performance in the last 1 month, well, the high on TCS, so today the stock closed at close to about 4,000, 4,003, 4,001 to be precise. But the high on TCS was on 18th of March, when the company went on and when the stock price was at 4,254. After that, we had Accenture numbers coming out. Then Accenture disappointed the street, and the stock fell to levels of, I think, about 3,830 thereabout. 3,829 to be precise. So the stock is currently somewhere between those two levels. It's about 6% off from its 52-week high hit prior to the Accenture numbers. So in a way, market can say that if there is no improvement in demand, the top line growth remains the same, maybe, it's priced in, because the stock has fallen 6% since the Accenture numbers. But in the last couple of days, we've seen the stock also recover from the day's low. Trying to get some more details in terms of what the dollar revenue numbers are. Okay, the company, we've got the full year number. One second, let me get the Q4 numbers. Okay, Q4 constant currency revenue growth has come in at 2.2% year on year. This is not the quarter-on-quarter number that we are awaiting. It's the year-on-year number. And revenue growth has come in at 2.2% in Q4 on a year-on-year basis. This compares with a 1.7% year-on-year revenue growth in TCS. So TCS's numbers are inching up. The revenue has come in at 7,360, I think. So that's slightly perhaps on the lower side. The street was expecting about a 1.5% dollar revenue growth. I think the company has delivered about a 1.1% revenue growth. So revenues are modest. Revenues are similar to what we've seen in December quarter. So no material improvement seen in the demand, or at least in the top line. But the margin performance is very strong. 26% margins, quarter-on-quarter expansion of 100 basis points, year-on-year expansion of about 150 basis points. Reading the statement coming in from the management, K. Krithivasan, CEO and Managing Director, we are very pleased to close Q4 and FY24 on a strong note with the highest ever order book and 26% operating margin, validating the robustness of our business model and execution excellence. In an environment of global macro uncertainty, we're staying close to our customers, helping them execute on their core priorities with TCS's portfolio of offerings, innovation, capabilities, and thought leadership. NGS, the COO and Executive Director, says, and I quote, our Q4 performance is robust, broad-based deal wins seen across industries and geographies. Samir Sikseria says, who's the CFO, in FY24, our disciplined approach to operations have helped us expand our industry-leading margins. In a challenging environment, we persisted with long-term investments in workforce reskilling, research, and innovation. So those are some statements that are coming through. The company has said the Q4 deal wins are very strong, $13.2 billion. This compares with $8.1 billion, probably boosted by the Aviva deal, which according to some reports was expected to contribute about $2.5 billion. So let me just quickly summarize the numbers that have come through right now. Revenue growth is at about 1.1%, slightly lower than street expectations and similar to the December quarter. Margins are a beat. Company's margins are 26% ahead of street expectations, and deal wins have gone up substantially. The overall deal win stands at $13.2 billion, and with this, the company's ended its order book at an all-time high level. So deal wins at $13.2 billion also suggests that it's gone up by 63% on a quarter-on-quarter basis. And on a year-on-year basis, we've seen the deal wins up 32%. The other number that we wanted to find out is what the headcount is this time. So, we'll get to that in just a bit. But let me get in Prakash Diwan and Moshe Khatri on the show now. Moshe, first question to you. Revenue growth appears to be modest, but there is a big margin beat, and that has come in as a surprise.
Mixed quarterly results, that's number one. We knew that the March quarter is going to be muted in terms of growth, given the fact that budgets have been pushed out and budgets have been delayed by about 2 months. We are assuming that now that budgets are finalized, and in our view, they've been finalized by the end of March, we should have that bump in terms of sequential growth starting in the June quarter and following that. The deal wins, as you said, they're at record levels, and these also should help the revenue growth once they start converting. So it's a net mixed quarterly results, not a huge surprise on the revenues, maybe even better than feared given the booking numbers and the margin numbers. Okay.
Looking at the year-on-year revenue growth for geographies, BFSI continues to remain weak, so down 3.2% on a year-on-year basis. And the consumer business is seeing a decline. Apart from that, technology and communication. So the usual headwinded verticals are weak. That's BFSI, communication, and technology. And in terms of geographies, it's Americas, which continues to remain under pressure. Americas revenue growth has fallen 2.3% on a year-on-year basis. Prakash is with us on the show. And one more number, attrition has come in at 12.5%, which compares with 13.3%. Prakash, the stock rallied today. I mean, in a weak market, it held up okay. Do you think there is enough in these numbers for the stock to outperform?
So, you need to look at the numbers in context of what's not worked. And in spite of what's not worked, you still have a decent improvement in margins. The first thing is that there was an expectation that BFSI is finally turning the corner, which doesn't seem to be the case, which means, as Moshe rightly said, you could probably have the current quarter ending June, you could probably see some sort of a pickup or normalizing there. The second thing is North America, which was, again, likely to be one of the key drivers for growth, either revenue or probably, the new wins that they've talked about. That also seems to have not kind of, been chugging along so well. So the bad news is actually going to translate to good news as far as the stock is concerned. With 26% margin, and remember, last quarter, you also had the epic adjustment. So from that perspective, this seems to be a very decent jump. And the commentary itself tells you that there's no cause for concern or worry in any of the comments that we've seen till now. So what typically would happen is they've completed the financial year, on a high of sorts. At least they've not capitulated given the weakness in demand and all. But going forward, the stock will start anticipating some sort of an improvement which can be meaningful. And hence, you still have the stock closing at almost close to 5% off from its recent high. So that could probably be taken away, and a new benchmark and a new band could probably be set above the 4,000 mark. So I definitely feel the numbers are decent enough. There's nothing to worry. The stock would continue seeing some sort of an accumulation and build up from here on as well.
Oh, no, I agree. And I take your point that there is nothing majorly negative in the numbers. Q3 was a positive surprise on revenues, boosted by the BSNL deal. This quarter too, the top line, you could say it's slightly lower than expectations. But again, it's not that it's fallen off the cliff. It's largely similar to Q3. And there is that margin expansion which will support the stock price. Moshe, do you get the sense that earnings have bottomed out? It's two consecutive quarters where revenue growth is largely similar. Would you say that earnings have bottomed out for the IT companies? And what is the recovery that you anticipate? And when will it take place?
Hypothetically, they have, especially if our thesis is correct in terms of budgets being finalized by the end of March. That means that you'll have fresh funding for new programs. We're looking for a slight uptick in June, stronger in September. And again, if some of those deals really start converting, you may even have a better than usual December quarter, which is seasonally weak. So it's definitely a back-end loaded year for the sector. We've seen these years in the past, and what's supporting that is the deal flow that's been super, super strong in the past 9 to 12 months.
Okay. So Moshe, what's the investor view now when it comes to large cap IT? They have a choice between a TCS, which is, got a leadership position. This year, it's going to see growth above peers, like say, an Infosys. Its margins are industry leading. It's been the bellwether, and in FY24, it's likely to report, numbers stronger than its closest peer, Infosys, and probably even in FY25. Given the kind of deal wins the company has seen, it will boost the company's, revenues, prospects in FY25 as well, because all these incrementally won deals, whether it's BSNL or Aviva in this quarter, they will all contribute to the top line in FY25. So what's the investor view when it comes to choosing between the large cap IT? Which one do they prefer and why?
So first of all, Rima, the investor base in the U.S. remains relatively skeptical about this so-called bump or recovery that we're actually talking about right now. And the sentiment shift really happened after Accenture came out with their numbers. So I think at this point, and I don't know if TCS's results on their own, unless management says anything else, is going to sway people to change their sentiment about the next few quarters. I do agree that at this point, from a large cap perspective, TCS seem to be in a pretty decent shape to show that bump or sequential improvement starting in June versus some of the other names in the space. Remember, TCS doesn't provide annual guidance. Infosys does, and we are expecting Infosys to provide pretty conservative guide. I think some people are talking about 3 to 6%. We're actually looking at 2 to 4%. The good news on Infosys is that Street's expectations have been reset pretty drastically in the past 3 months. Some people are looking for 8 to 10% growth. Now we're somewhere in that 6% growth. We're at 5, and I do think that the estimates will be even more conservative here when they are provided next month.
Prakash, what explains this margin performance for TCS this time?
So I think,
and is this something we can see from the rest of the IT companies?
So I don't think this is going to be across the board. It's the nature of new contracts that they announced last quarter, which the current quarter, which is earnings have come for. Very clearly, it's not something which will be only in this quarter. The Aviva deal could actually continue to yield much better utilization levels as well, and that efficiency will help improve, keep the margins elevated. The second thing is the BSNL order as well. It's not something which would be getting over this quarter or the last quarter. It started on last quarter. It's started showing, some traction. And I think it could probably go into first half of 24-25 as well. So you have these significant things moving, which are moving in the right direction. And remember one thing, they have made themselves much leaner, as you rightly said in the beginning. I remember, when you said the last 4-5 quarters, we've seen the systematic reduction in headcount, and that means that today they would be sitting on a much more leaner bench in terms of whatever contracts that are getting executed and the new wins that they talked about. 13.2 is a significantly large book to kind of start going after. I don't think this is the case with a lot of the other largest players. We've seen how Wipro has been struggling. We've seen how HCL has been sporadic with some of the stuff, though they had some very good contract wins. But TCS will probably be more consistent, and that is what rewards them usually as the bellwether and accords a higher P multiple. So I would believe that will continue, Rima, though there's nothing very dramatic in terms of an improvement. The worry was after Accenture numbers that things could probably be much slower, much more painfully slow to recover. And remember, I mean, this is an off the tangent kind of a thing, but the BMW tie-up with Tata Technologies is something which is an indicator that largish orders from some of the large principals would start kind of coming through. If March end is when most of these things crystallize, we'll probably see the impact of some of this into the April, May, June quarter. So I think this is not one-off. It will continue, but it may not be the case for all the large players in the same way. They have their own issues, and this is a completion of one full year where the new management came in. It's like end of the financial year for the new management. Gives you that confidence because at least the continuity will probably start showing its positive effect as well going forward.
Moshe Prakash, thank you very much for joining in with your insights. For those of you who've just tuned in, let me tell you 5 things about the TCS's numbers this time. Revenue growth has been similar to the December quarter. Constant currency revenue growth at 1.1%, lower than consensus expectations of 1.3%, but similar to December quarter's numbers of 1%. So there is no improvement in growth as of now. Where TCS has flexed its muscle is on margins. EBIT margins have come in at a 3-year high at 26%, expanding by 100 basis points on a quarter-on-quarter basis. The third one is very strong deal wins. Deal wins have come in at $13.2 billion, a 63% jump on a quarter-on-quarter basis, 32% on a year-on-year basis, and even for the full year, the total deal wins are at a record high, crossing $42 billion. Sectorally and geographically, the headwinded verticals, whether it's North America, in verticals, it's BFSI, telecom, communication. On a year-on-year basis, these sectors and geographies continue to record a decline. These are year-on-year numbers. North America, BFSI, telecom, and communication. And finally, attrition continues to tick down, now at 12.5% versus 13.3% on a quarter-on-quarter basis. So numbers on the whole, the positive is on margins. But remember, today the stock closed up with a gain of about 0.5% at a time when the rest of the IT pack was down nearly 1%. We're going to take your leave. We're going to get into a very short break. We'll come back with more news and updates on the other side.